Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories within corporate filings, and today we're looking at Becton Dickinson and Company, or BDX, and their latest report from the 9th of February 2026. It seems like they're giving us a peek at their financial results. But is it all good news, or are there some subtle signals we need to pay attention to? Before we dive in, if you are into understanding what these company reports really mean for your investments and the world around us, make sure you hit that subscribe button. And hey, we've got a fantastic community growing over on Discord with the link right there in the description below. Come join the conversation. Alright, so Becton Dickinson, a big name in medical technology, has put out a report that mostly revolves around their financial results for the first fiscal quarter, ending the 31st of December 2025. What is really interesting here is that they are highlighting certain financial numbers that are not exactly in line with the standard accounting rules we usually see. The generally accepted accounting principles, or GAAP, they call these non-GAAP measures. While they say details are included in their press release, this is a big signal for us. It means they are presenting a picture that might look different than what a standard financial statement would show, and we need to dig into why and what that means. This report is filed with the US Securities and Exchange Commission, or the SEC, which is the government agency that oversees the stock market. Becton Dickinson is based in New Jersey and is a publicly traded company, meaning its shares are bought and sold on stock exchanges. Looking at their stock itself, the company has common stock listed on the New York Stock Exchange, ticker symbol BDX. They also have several types of notes, which are essentially different kinds of debt they've taken on. Also listed on the New York Stock Exchange, we see notes maturing in 2026, 2031, 2032, and even one out in 2036. This tells us they are using a mix of their own stock and borrowing money to fund their operations and growth. The interest rates on these notes vary from around 1.2% to 3.8%, which gives us a glimpse into what they're paying to borrow money at different times. The core of this report is about their financial results. They issued a press release on the 9th of February 2026 to announce these results for the quarter ending the 31st of December 2025. Now remember that bit about non-GAAP measures. That is often where companies try to show a more favorable view of their performance by excluding certain expenses or income that they deem unusual or not indicative of their core business. For us as investors or observers, this means we have to be extra careful. We need to understand what those exclusions are. Are they truly one-off events? Or are they masking ongoing issues? For example, if a company excludes restructuring costs repeatedly, it might suggest that their business model itself is not as stable as they want us to believe. So, while the company is signaling their earnings, the real story might lie in the adjustments they are making. Now, let's think about what this means for Becton Dickinson. They are in the business of making medical devices and equipment, a sector that is generally stable and even grows as the global population ages and healthcare needs increase. However, competition is fierce and innovation is key. When a company reports results and then provides a separate set of adjusted numbers, it is like giving you two different photos. One might be professionally lit and angled, while the other is a candid shot. We need to consider both to get the real picture. What are the potential implications of using non-GAAP measures? Well, it can make it harder to compare the company's performance directly with competitors who might be sticking strictly to GAAP. It can also make it more challenging for investors to assess the true profitability and financial health of the company. For instance, if Becton Dickinson is excluding costs related to integrating a new acquisition, that is one thing. But if they're excluding something like the cost of goods sold, that is a much bigger red flag, suggesting their core operations are less profitable than they appear. When we talk about financial reports like this, the key is to always look below the surface. These reports are required by the SEC to provide transparency, but sometimes that transparency can be clouded by the way numbers are presented. The fact that they are specifically pointing out these non-GAAP measures tells us they want us to focus on these adjusted figures. Our job is to question them. Are these adjustments truly providing a clearer view, or are they a way to paint a rosier picture than reality? In Becton Dickinson's case, their business is critical. They make things that healthcare professionals rely on every day. So, understanding their financial performance is not just about stock prices, but about the sustained ability of a company to deliver essential products. If their underlying profitability is weaker than reported, it could eventually impact their ability to innovate, invest in new technologies, or even maintain their supply chains. And finally, to wrap things up, this report is signed off by individuals within the company, like Stephanie M. Kelly, who holds a key legal role. This is standard procedure, confirming that the company is officially submitting this information. Now, what is my take on all this? Becton Dickinson is a solid company in a vital industry, however, the emphasis on non. GAAP measures in this report is a signal that requires caution. It means we absolutely must look for that accompanying press release and meticulously examine the adjustments being made. Are these adjustments justified and transparent, or are they a form of financial engineering designed to present a more favorable, but potentially less accurate, view of their performance? Without seeing those specific adjustments, it is hard to make a definitive judgment, but the very act of highlighting them suggests there are factors affecting their performance that they prefer to discuss outside the standard GAA framework. The key takeaway here is to question what is being presented. True financial health is often revealed not just by the headline numbers, but by the details of how those numbers are calculated. For Becton Dickinson, the strength of their business will ultimately depend on their ability to innovate and operate efficiently under standard accounting practices, not just under adjusted ones. Alright, that is our breakdown of Becton Dickinson's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think these non-GAAP measures are helpful or a cause for concern? Drop your thoughts in the comments below if this analysis was valuable. Hitting that like button really helps the channel, and subscribe for more deep dives into the world of corporate finance. And if you enjoyed these discussions and want to connect with other like-minded individuals, don't forget to check out our Discord community in the description. Thanks for watching, and I'll see you in the next decoding session.